How are you guys today?
Good. How are
Doing
you?
well, doing well. We
Good.
survived the great hurricane.
Yeah, how is the weather? I'm not in New York today. How's the weather?
Beautiful, sunny, warm,
No more trees or anything like that?
beautiful. Not not this time, not this time.
Anna, how are you today?
Good. Doing good. It's a nice Wednesday.
Warm. Awesome, awesome. Life is good, guys. We're now in August. It's probably the craziest year in the world. So hope everyone that watches this is holding up well and you guys are finding ways to stay happy and stay awesome like you all are. Um, this whole kind of broadcast is just a monthly thing that we started doing about the state of the market. So we'll kind of go through, what we're seeing in the market, what we're seeing in the mortgage rates, what we're seeing in kind of the rental market, and then just some housing trends, things like that, and then kind of wrap it up. So just kind of talking about the July Brooklyn market, just want to kind of go into some statistics here. So we saw overall in Brooklyn, this is according to StreetEasy's data, we had 604 overall contracts signed. Out of still 4,787 properties still available in the market. That's an absorption rate of 12.62%. For people on the call here who don't know absorption rate, the premise is absorption rate essentially says that it essentially calculates how long it would take to sell through all the available inventory on the market. So, all things being equal, price not being a consideration, it's saying there's 7.9 months of total inventory in the market right now based on the amount of contracts signed in July. So just breaking that down a little further, contracts signed under $1 million, we had 371 in Brooklyn, and 200 of those have been signed since July 21st. Absorption rate a little better there, 15%, about 6 months, 6.75 months of total inventory. $1 to $2 million market, we had 184 contracts signed, absorption rate of 12.4%, or 8 months of right around 8 months of inventory. $2 million plus in Brooklyn, we had 49 contracts signed total out of 813 total available properties. That's an absorption rate of about 5.9%, or about 16.67 months of total inventory. So is that kind of consistent with what you guys are seeing out in the market right now?
Absolutely. I mean, as this kind of suggests, the entry level is moving much more briskly. The Brooklyn market, much like the larger New York market, is seeing a glut of high-end property that's moving slowly. And generally on the high end, you're seeing larger and larger concessions.
Right. Yeah, I'd say the pace of contracts signed under $1 million, I've never seen them move so quick in July previously, ever. But I think a lot of that has to do with kind of the shutdown and pent up demand and things like that. So we're seeing, at least for my clients, we're seeing a lot of bidding wars in the under $1 million range. Not in everything, but, I've definitely been in a couple situations in the last 2 weeks where we've been one of 5 or 6 offers. So pretty crazy, to say the least. What else are you guys seeing out in kind of the market? How are inquiries, things like that? Pretty strong?
As far as listings go, it's mixed. Things that are priced well or realistically are getting traction, but there's definitely a little bit of disconnect between the sellers and the buyers right now. A lot of people are not quite ready to start cutting prices, but the buyers out there feel like they have the upper hand and are throwing out lowball offers left and right.
For sure. One of the things that I'm definitely seeing a lot, and this kind of speaks to the next section, is about negotiability and ask versus close. You know, I'm seeing a trend of sellers kind of being willing to deal and willing to negotiate, but they don't necessarily want to start offering up a lot of price drops. Rihanna, you were looking for the ask versus close. What do you kind of seeing there?
Well, you know, it's definitely mixed across the board, but, you know, like you said, in terms of pricing, this data is kind of reflecting of the time during the shutdown. So these are closings that just happened in July. And so we're seeing that people were still out there and people were still looking for some sort of, you know, price drop, you know, some sort of discount, you know, especially buyers who were looking during that time. But it is a positive because it definitely shows that people are still out there even during such a crazy time in the world, you know?
Yeah, I mean, you've got people, you know, and for a lot of the stuff that closed in July. Now, granted, I would say probably 8 out of 10 properties closed under the asking price to some degree, but be mindful, like, the people weren't actually able to go see these properties in person. So a lot of these deals were made based literally on video, you know, and like, you know, FaceTime walkthroughs and things like that, right? So to me, that kind of speaks to a more resilient market in that, you know, there was still demand even when you physically couldn't walk into, you know, a $1.5 million brownstone or something like that, right? So what are you guys seeing when you look at kind of mortgage rates right now, right? Because that sort of dictates a lot of the market. Brianna, what are you seeing out there for like 30-year fixed and things like that?
Yeah, you know, they seem to be, you know, hovering around that like 3.25%, you know, 3% rates depending on the mortgage type that you're getting, you know, which most people know by now because it's talked about so often that this is a historical low in terms of traditional mortgages, interest rates. Um, and you know that has definitely had an effect on people's willingness to consider properties that they may have not considered before, you know, definitely taking advantage of the interest rates and kind of looking at it. If you think about, for instance, like 2 years ago, you know, 2018, right? Those interest rates were, I want to say, if we averaged it, they were close to like 4.5, 4.6%. And, you know, when you break that down and you look at your, for instance, like the amortization schedule, and you look at how much you're paying towards your principal and what have you, it's a very obvious benefit to be considering taking out a mortgage right now with these current rates.
Right, for sure. It's, you know, I think one of the key things that I've been telling people, and I'm sure you guys have as well, is to like really look at the amortization schedules right now, right? Because just the difference of a point and a half in mortgage rates can be like the difference of hundreds of thousands of dollars in interest over the life of a loan, right? So, but all good things come with, you know, some catches, right? So there's some factors that we're hearing in terms of qualifying for mortgages that are a little bit kind of unique to this market. Do you guys want to talk about that a little bit?
Yeah, yeah. You know, we were recently on a call with a lender, for instance, at Wells Fargo, and they were telling us that, you know, for those who are looking at multifamily properties, you know, 1 and 2 family properties, they are no longer considering, for instance, like your rental income. So if you were thinking, oh, you know, I could, you know, buy a condo, but, you know, I'm really considering buying a 2-family. That way I can sort of, you know, reduce your mortgage over time because you have that rental income. At this time, they're not considering that rental income in your like debt to income ratio and therefore your ability to afford the mortgage, right? So that's been a huge factor for people who are now looking in that sort of scenario.
Right. And then and that may be specific to New York City right now. I've definitely talked to some lenders
Yeah.
out of state that do not have that specific restriction right now. And I think that it will be temporary. I think that, you know, the rental market's in an interesting time to say the least. So banks tend to be a little more conservative. And then you're talking about, and also we've had some notes on just reserves for post-closing assets, right?
Yeah, so previously the standard was that the lenders were looking for you to have 6 months of reserves of your mortgage payments. So 6 months of mortgage payments after you paid for all of your closing costs and what have you. And now they are looking to have people have 9 months of reserves. So, you know, you really have to think about that when it comes to how much you're putting down and, you know, all of those factors in terms of your loan. Because not everyone has that extra, you know, 3 months of their mortgage payments just laying around.
Yeah. It also just kind of factors maybe how much you can put down, things like that.
Exactly. Yeah.
Right?
I mean, for a Brooklyn townhouse, you're talking about, you know, anywhere from $10,000 to $30,000 in additional cash reserves that you're going to need to factor in.
Right, totally. That may for some buyers, you know, at certain price points, that may be the difference between a 20% down loan or a 15% down loan, right? Which can trigger PMI, which can change the game a little bit in terms of debt to income ratio and things like that. Ryan, this is probably our favorite loan in the world. What are you seeing in like construction loans and things like that? I know we're always looking at that stuff.
Yeah, I mean, so for investors right now who are looking to, you know, pick something up and do a renovation, there's actually some incredible products out there. We have a contact at TD Bank who was telling us about some of the products they have at the moment. You know, they're still offering 99% financing on 1 and 2 family products, HELOC piggybacks with no PMI, and the rates are unbelievable. You know, he was quoting us 3.25% on a 30-year fixed, which is, you know, practically the same as a traditional jumbo loan.
Unheard of, right?
So this is to finance, you know, the purchase and the renovation.
Yeah.
And then they have 10-1 arms at 3%, 5-1 arms at 2.75%, and all of those are with no points. So, you know, you're not taking money out of your pocket to try to get yourself a better rate.
Wait, although we kind of refer to them as investor loans, these are construction loans designed for owner occupants, right? Like, let's say that you want to do your own gut renovation or something like that, right? That's kind of how that loan works, right? The bank will loan 80%, generally, sometimes a little more, sometimes a little less, of the total cost of the project, the total cost of the acquisition of the building, and the construction cost is kind of an all-in-one loan, right? So still really cool. You know, the one thing I would say for those of you guys listening, that if you want to look into something like this as a homeowner, these rates are unheard of for construction financing. I mean,
Exactly.
developers are paying 8%, 10%, 12% at times for construction loans. You can get them for under 4%. It's just unbelievable, right? So,
yeah.
What are you guys kind of seeing like in the refinance market?
I mean, if you have a mortgage, talk to your mortgage banker, see what they can do for you. You know, everyone should be looking into a refi right now. Obviously, the wait times, you know, underwriting is taking, you know, 90 to 120 days. So don't expect it to be quick, but in some instances, you might be able to apply for a mortgage rate amendment, which would not have any additional underwriting or closing costs. This is something that I'm in the process of applying for right now at Wells Fargo, and they might be able to knock, you know, an 1/8 or 1/4 point if you got your mortgage fairly recently, and that's without any additional underwriting, no additional closing costs. They would basically, you know, take another look at your loan with the original documents and, you know, see if they want to give you a little bit of a break.
Yeah, it's pretty nuts, right? Like, I know friends of mine and past clients that literally, they got their loans in 2018, right, at like 4.5 or something like that, and they're saving literally years off their mortgage rate right now. So if you guys have a loan anywhere with anybody, like, take advantage of the moment, because nothing gold stays forever, right? None of us are mortgage brokers on this call, but we all care about saving you money. So,
And a lot of lenders are restricting cash out refis. So if you're thinking about taking money out, maybe now's not the time. But if nothing else, you could lower your monthly payment or take years off your amortization schedule.
Totally. Good stuff. So let's move on, guys. Let's talk about the New York City rental market. Very interesting times, to say the least, right? So, Orion, I know you've been out there kind of showing apartments like there's no tomorrow, right? So there's people in the market, but definitely seeing kind of some things that we're not used to as real estate brokers in New York, right? In terms of pricing concessions or vacancies, things like that. Do you want to talk a little bit about that?
Yeah, absolutely. I mean, basically throughout the shutdown in New York City, landlords were happy to have people overstay their leases, keep them on month to month. With the city reopening now, you have 3 months worth of rentals kind of hitting the market at once, and the whole city is kind of playing a game of musical chairs as people shuffle around. There's definitely an exodus, people taking advantage of, flexible remote work policies, who want to get out of the city, save a little money, go somewhere warm. But, there's still, New York is still New York. So there's always demand. What's really surprising is even now in the peak of the summer, which is typically the strongest rental season, we're seeing prices continue to decline, roughly 2 to 3% across the board in Brooklyn. The new development market is getting absolutely hammered. You have these high-end buildings that are just opening up, fully vacant, and they are offering 2 or 3 months free rent, in addition to cutting monthly prices by up to 5%. So, all in, you're looking at 20% discounts just to try to fill these vacancies. This is unheard of in the New York City market.
Yeah, we heard I was on a call the other day with one of the managing brokers at Corcoran, and he was speculating that the vacancy rate may be upwards of like 15% in between Brooklyn and Manhattan, which is, just to give you guys a sense of reference, like that vacancy rate is usually about 2 to 3%, right? So
it'll be very interesting, because if these vacancy rates hold, New York City's system of rent regulations could be endangered, since that's actually based on a housing emergency defined as a vacancy rate of 5% or less. There's actually an official vacancy survey that's expected to begin next year. So we'll see how the city reacts to the new reality.
That creates a whole host of interesting conundrums, right? So do people, do landlords in those groups, do they now keep their apartments vacant and warehouse them so they can keep the vacancy? Some of the larger kind of portfolio landlords and things like that, to keep that vacancy rate up higher. Does the city come in and kind of, step in there, change the laws, which is probably what, just based on the last couple of years in New York, the way that I see that going. But time will tell, right? If you're a renter right now looking for an apartment, like, just, like everything else, knowledge is key, right? As we say that the vacancy rate is high, that we're dropping prices, we're not seeing that everywhere, right? Like some properties, like I know we just had one recently in Bed-Stuy that was like, on fire, right? Like multiple applications, your phone was like off the hook, right? So
yeah, I mean, anything that's priced reasonably, that has good size and outdoor space is still moving quickly. You know, what's getting hit the hardest are kind of the smaller, higher end apartment buildings where you sacrifice size for amenities. And now all these buildings, you know, all the shared amenities are closed. The gym is closed. The movie theater is closed. The bowling alley is closed. So, you know, you're not getting any value for your money. You know, duplex townhouses and just, you know, larger 2 and 3 bedroom apartments are doing well, especially because of the work from home trend. People are just, you know, they're looking to have as much space as they can get for themselves. And outdoor space is at a premium like never before.
Yeah, and I would say, and I think you guys would agree, outdoor space is probably the number one. Private outdoor space is probably the number one amenity.
Yeah.
Yeah, I don't think there's going to be a vacant townhouse with a backyard anywhere in the city.
So it's just, you know, that kind of creates, like, especially as, like, you know, landlords are listening in today, like, be strategic with pricing, right? Know where your wins are, right? But don't be too optimistic, because there's plenty of owners that I know personally that were unwilling to listen to pricing recommendations that we made to them, and you know they're sitting vacant now 2, 3, 4 months, right? So it's going to be knowledge is power, and being realistic is being pragmatic right now, right? So let's talk about just some housing trends, guys, because it's there's a lot of mixed messages out there, just in like different articles on housing versus kind of specific to New York City articles. What do you guys think, like, we're, you know, none of us have a crystal ball on this call, but what do you guys think we're looking at moving forward here?
The things that I'm looking out for that are going to have a huge impact on the real estate market. I'm keeping an eye on the Fed's benchmark interest rate. You know, with this loose monetary policy, everyone's expecting inflation to start ticking up eventually. If they're forced to start raising interest rates, you know, you're going to see mortgage rates go up. You know, I wonder if that'll potentially cause like a last minute surge in buying. Right now, people kind of are hanging back, seeing if the rates will go even lower. So if those start ticking up, that might cause a huge swing.
Right, for sure. Brianna, what about you? What are you looking at moving forward?
I mean, I like to be, you know, super focused on what's going on locally. And also, you know, I like to think that, you know, seeing these articles, for instance, like Spotify, you know, claiming that they're going to stay work from home through July of 2021. That was like the most recent update. You know, those are factors that I think definitely play into, you know, people who are working in those larger markets where, for instance, like Spotify and Google are present. You know, I think those are definitely huge factors to consider, because you know, people can choose to stay, but they can also choose to, you know, rent a house upstate, or, you know, buy a house upstate and still have extra funds in their pocket because they're not paying that premium, you know?
Right, for sure. I guess we'd be remiss if we didn't look at the election as well, right? I know historically in election years, that's always had a interesting impact on the real estate market. So, you know, this is probably an election like no other in the history of the United States, right? So maybe we've already kind of been in that like 24-hour news cycle now for the last like 4 years. So maybe it won't be as dramatic this time around, but only time will tell. You know, and Orion, to one of the points that you were making earlier, just about like the loose monetary policy, inflation is a very real possibility, and you know, kind of moving forward here, right? Because it looks like we're going to need more stimulus to kind of keep the economy afloat, right? And to me, you can't just keep printing money without inflation throughout the economy, right? It's just simple science. So sometimes inflation cannot be the worst thing for real estate, especially if you are locking in your interest rates at such a low number, right? Because you know, a lot, we're seeing, and I'm seeing this amongst our investor clients, a lot of them are getting out of some equities because of the risk of inflation and actually looking, I'm getting a lot of unique calls about investing in real estate because of the risk of inflation. So, you know, other things, the remote work thing, I think is pretty much all the tech companies have made a similar announcement, right? Like Spotify, Google, Facebook, you know, all work from home. One of the things that I found interesting is that they're starting to put out a lot of news that they're not going to be willing to pay people the same salaries if they relocate out of these major metropolitan areas. So I guess, I don't know what that's going to look like. You know, we'll see what happens with like just schools and just different phases of reopenings and kind of where we land with like, you know,
Yeah.
COVID and everything, right? But
I think all of that still is going to have like a huge impact on people's decisions to whether that's to where they decide to plant their roots, whether that's where they, you know, decide like what neighborhood they want to live in, how much they're willing to pay to be in those neighborhoods. You know, there's certainly, you know, areas where people will pay the premium because it's in the school that they want, or, you know, next to the bakery that they need to be next to. So
totally. Yeah, I mean, I guess the one thing I'll say to that, and I think we can all agree, is that purchasing real estate is a long-term investment. So sometimes you have to not be so consumed in the news at the moment, because building equity is a long-term play. It's not a get-rich-quick scheme, right? So you've got to be very intentional about your longer-term goals and how real estate factors into that, along with, you know, career goals, family goals, everything else, right? So good stuff, guys. Well, I guess that's kind of all the topics that I had today. Any kind of final remarks?
I mean,
Yeah.
I think overall, my takeaway from this is, you know, if you're considering, you know, your next move, whether that's in real estate or, you know, relocating, what have you, you know, pick up the phone and have a conversation with someone, you know, get more educated on whether that's interest rates, you know, the amortization schedule, you know, new development, all of that, you know, have a conversation and at least be informed of, you know, what the possibilities are. Call us up.
Yeah, you know, whenever there's volatility, there's opportunity. So now more than ever, you want to make sure you're well informed. You want to kind of keep your spear sharp, and, you know, be ready to make a move if it's makes sense.
Yeah.
What is the Warren Buffett quote? Be fearful when others are greedy, and be greedy when others are fearful, right? So
Exactly.
however you interpret that into your own life and your own decision making, you know, it's a good time to make deals right now, guys, and they could pay off for you very well in the long run. So very good. Awesome, guys. Well, I appreciate y'all. Appreciate everyone for tuning in today. And we'll be back again in September to talk about August. And
it'll be a whole different world.
You never know, right? One day at a time, right? So, all right, guys. Well, thanks so much for everyone for taking the time with us today. If you have any questions, you know how to find any of us. And we will talk to y'all soon. Bye-bye.
Be well.